Hi, good evening, everyone. This is my first video on macro variables which are going to impact capital market movement from 6th to 10th October. So I'm planning to have this series of videos every week, and this is my first attempt in putting all the things together which is important for an investor uh, in choosing the right kind of themes, right kind of stocks, right kind of investment for them. There are a lot of variables actually which impact the overall movement in capital market. So I will be focusing more on the variables which are actually impacting the market. It could be international variables, it could be domestic variables, and it could be interrelated variables as well. So let's start this video. The first variable which is impacting, which has an impact, a direct impact on Indian capital market is oil prices. Now, oil prices has been quite consistently, in range bound manner. It is approximately at $64.77 dollar. The Brent crude price is at. This price is going to be slightly softened down, mainly because OPEC Plus is probably going to increase the production because I guess Saudi Arabia wants to have a higher share of overall oil market. That is the reason why they will be probably increasing the oil output. Given that we have slightly sluggish demand overall, the oil prices are going to come down a little bit. So in my view, it would be approximately 61 to 62 dollar per barrel of Brent crude prices, which will definitely impact positively for Indian bill of payments, and it's a positive news for us. It's a positive variable. The second variable which we'll talk about is dollar index. The lower the dollar index, it's better for our currency. Lower dollar index means that our currency will appreciate. Appreciate means the currency which is rupee to dollar will go down. As of now, dollar index is hovering at around 97 to 98 level. It has come down from 106 to 97, 98. It has came down to 96 as well. Now there are two big factors which are actually impacting dollar index on the lower side. The first is definitely the shutdown by US government, the US government shutdown, which is actually making the dollar index more and more weak. The more and more delay in opening up the market or opening up the shutdown, it will impact a lot on the strength of dollar. Second factor is strengthening of yen. Yen, which is a Japanese currency, it has been strengthening over a period of time. The new leader that has been elected in Japan is also not known very investor friendly. That will have a positive impact on strengthening of yen. Second thing, or third thing rather, would be a strengthening of euro. So if euro is at all-time high, and hence it is having a negative bearing on dollar index. So my view about dollar index is it will further go down to a level of 96 or maybe to $95, which was again a positive variable for Indian markets and especially for Indian currency. Third variable which is related to dollar index is US bond yields. We have seen slight increase in US bond yields, which recently has gone down below 4%. I'm talking about 10-year yield. It is increasing and it is at 4.119% currently, and it is slotted to increase slightly more, mainly because of government shutdown in US. Higher the bond yield, it's not good for US market. The money will flow from US equity market to the bonds, but this movement is definitely not going to be swift. Movement of investors from equity market to treasury bond in US is not going to be that swift or in bulk. But yes, definitely the movement will be there, which is not good for US equity market. Now, why the bond yield are increasing is mainly because of, again, the government shutdown. Second thing which is actually weighing a lot on the bond yield is the non-farm data, non-farm payroll data. Though the estimates are not there, but from the government side, but from the private side, it could be the joblessness is increasing in US. So that has an impact on bond yield. That has an impact on the probability of interest rate cut. We will talk about that thing slightly later. But overall, bond yield are slightly going to be higher, and it's not a very good news for US equity market, and it is really don't have much of a bearing on Indian equity market. So I would say US bond yields are a neutral variable at this point of time for us. Fourth variable is FII-DII flows. This have a very large impact and very direct impact on Indian equity market. So FII has been consistently selling in India market, and we have seen for last 3 months the selling of FIIs in cash is actually in the range of 35,000 crore to around 45,000 crore. But the good news is that the quantum of FII selling in a month is actually slowing down, which is a good news for Indian market. On the contrary, domestic equities or domestic institutional sellers or domestic Indian investors have been consistently buying, and this is the trend for last 3 months. Though the quantum of buying of DIIs in cash is also slowing down, but not in the proportion to the slowness of FIIs. So which means that while FIIs are selling, their selling is coming down. DIIs are purchasing, but the purchasing is slowing down, not slowing down a little bit. So in a way, the balance of FII and DII are actually the purchase of FII, the selling of FIIs and purchase of DII are actually favoring Indian equity market. So this factor is again a very positive factor for Indian equity market because it is having a direct bearing on Indian equity. The fifth factor is Indian buffer factor. The buffer factor is nothing but the ratio of the total market cap divided by the GDP of a particular nation. At this point of time, if we benchmark ourselves with key markets, which is US is sitting at a buffer factor of 217%, which is heavily overvalued. The ideal percentage is approximately 110 to 120. India is sitting at 136.37. So we are slightly overvalued, I would say, but US is extremely highly overvalued, which can be one of the big concern for US equity market, especially the rally in US market is on count of stagnating inflation and basically the upside which IT stocks, or I would say the AI stocks, have given in US market, which has actually created a sort of bubble in US equity market, and actually now earnings are not supporting the growth that the market is actually showing in US. So this is actually leading to a scenario wherein I would say it is a sort of a tech bubble that US equity market is going to see, and it is quite indicative through Buffett factor, which has actually crossed 200% for US market. So while it's not a very good sign for US equity market, but for Indian equity market, looking at 136%, and it has been consistently at 130 to 136%, we are fairly valued. Indian equity market is fairly valued, and it's a very positive, I would say, indicator for investors in Indian equity market. Now let's talk about the interest rate cut discussion. First, I'll touch upon how RBI has given a boost to Indian market, and what is actually happening in US, because the US interest rate discussions, US interest rate cut, and the commentary around that is having a bearing on entire world equity market. So RBI governor has not cut the interest rate this time, obviously because the inflation is actually on the lower side, but due to tariffs, which might have a bearing on Indian market, they didn't want to take the risk, and hence they have actually stagnated the cut, or they have not done the interest rate cut. On the other hand, if you see in the US, since the data of non-farm payroll as well as the labor market data is not available to Fed, they are slotted to have a discussion or the meeting on 28th or 29th of October for rate cut. It is very difficult for them to take decision on interest rate cut. Though Jerome Powell has already told that he is quite bullish about having 2 rate cuts in this financial year. For 1 rate cut in 28th or 29th of October, the market is pegging around 97% probability. But the second interest rate cut is where actually the challenge would be. If the coming meeting of Fed on 28th or 29th is not yielding, or maybe if it's yielding a 0.25% rate cut, but the commentary for the second rate cut is not positive, the market can actually get into, the US market can get into a crash mode. My prediction is the situation in the US is of a bubble. Interest rate cut decision is by and large forced by the incumbent government there on Fed, despite the data not being very supportive. In last meeting by Fed chairman, and his commentary was very clear that tariffs impact has still not fully seen in US inflation data. Though it's not transitory, but it can have an impact in longer term. Thus, I would say US interest rate cut is very tricky situation. It can go here and there. Market has taken all the positives, market has discounted all the positives from the US rate cut decisions, which they are discounting 2 rate cuts. But in my view, it could be 1 rate cut, and that could be crashing for US market. And hence, you could see a flow of investment from US equity market to emerging market. Since India is poised at 136% buffer factor, wherein we are slightly, not overvalued, but slightly overvalued, there could be a good FII buying which can happen in India market very soon. That can actually start from the festival month which we are in. So interest rate cut decision is going to impact Indian market directly and in a very positive way. Now coming to some geopolitical points, and these also have a very direct impact on Indian market. Though on domestic side we don't have any kind of a political risk or geopolitical risk, because whatever bad has to happen from US side when it comes to tariff increase or talks about or farmer 200% increase on specialized drugs, not on generic drugs, and all that is almost over, discounted, and market has reacted on that news. The coming month, the coming week, I'm not expecting any big news which can impact Indian market. The current news which is related to US is basically the Hamas and Israel deal. As per the latest update, though Hamas has actually agreed on the deal terms from US and President Trump, but they have not agreed on on certain things, wherein it was told that the entire Gaza will be ruled. I mean, they have not actually. They are pushing for a Palestinian state, but Israel and other players are actually not in favor of making it a Palestinian state. They want to have a board of governors and so on and so forth. So that kind of arrangement is not being agreed upon, though the hostage release and everything is being done, which will not add much of a value in terms of overall deal going to be. Ceasefire between the two nations is always welcome. It's a positive news. So it's positive news for the world, and it is also positive news for Indian equity market. Another thing which is of very important thing is, and I would also talked about the US shutdown. US shutdown is getting delayed. US shutdown getting delayed is actually bad for US equity market and not for Indian equity market. Third news, which is also very hugely important to all of us, is China is betting big on trade deal with US. China is proposing approximately $1 trillion investment in US, which will in turn, and they are expecting their tariffs to significantly go down. This will definitely help US-China trades very, very positively. And it is definitely not going to impact, or it is not going to be positive for India. Why? Mainly because still, when it comes to pharma sector, India is exporting a lot to US. And since there was a tariff increase of 200% on specialized formulation which was coming from China, India could have been an alternative. But since the US-China deal is going to be in a very positive way, they are going to have this deal with China committing the investment of $1 trillion. My view is it is not a good news for India. So geopolitically, I think we are going to see some kind of a negative impact on India market. So let's talk about the sectors which we should focus on. There are certain sectors which Indian market or Indian investors can focus on. Out of the 5 sectors which I think can give a bullish return in Indian market in slight 15 to 30 days kind of a period of time, that's FMCG, consumer durable, Indian IT, and Indian public sector units. So out of the 4, my suggestion is only the public sector unit, which is the PSE sector, and FMCG is going to positively return, to give positive returns in Indian market. Mainly because pharma still is under the cloud. We don't have much of a clarity, and though the impact on pharma companies, because most of the pharma companies in India are producing only the generic drugs, but there is always a cloud of uncertainty from Trump's side. If he will definitely include that as well. I mean, the generic drug producers as well under tariff radar. The second sector, which is IT, is definitely a very risky sector at this point of time, though IT is down, I guess, 5 to 6% on a yearly basis. But still, I'm not seeing any kind of a hope of revival in IT market or Indian IT market. It's mainly because of the protectionist policy by Trump regime, which is definitely going to be negative for Indian market or Indian IT sector. And hence, the only 2 sectors which I think can actually give a better return is the public sector units, because definitely they are more India focused, and FMCG sector. It's mainly because of reduction in GST, which is in GST 2.0, increase in the income tax waiver till 12 lakh income, as well as overall stability in Indian equity market. So these 3-4 factors definitely will push FMCG in coming quarters. And due to festive season as well, it is normally observed that pre-festival demand is very high. So FMCG is one factor that we can look at. So as a summary of this video, I can see market moving slightly positive in next week or next 10 days. The sectors I've already talked about, and most of the factors which may impact the Indian market, Indian equity market, I've already discussed. So kindly, this is my first video. I hope I would have been I would have been able to add some value for the investors who are looking at serious investments in Indian market. Uh, Hope to see more audience of this video, and I would request people who would have liked my video or disliked my video to please put comments so that I can improve from here on and can be of high value to all of you. And if anybody would have liked to subscribe to my channel, please do so, because this will encourage me to post more videos which could be valuable for all of you. Thank you so much.